You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. The Advisor's Option is also brought to you by Northern Trust Capital Markets, offering a unique blend of transparent trading, quality execution, and smart liquidity solutions across institutional brokerage, transition management, securities lending, and foreign exchange. Northern Trust's options offering includes quiet access to non-traditional pockets of liquidity, with hands-on support from experienced traders to customize your trading strategy, combined with the peace of mind that comes comes with trading through a stable and globally respected firm. To learn more, contact John Cherry at John_Cherry, spelled like the fruit, at ntrs.com or visit northerntrust.com/capital markets. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program here on the old network where we welcome you, the busy financial advisor or asset manager. Maybe you're already dipping your toes into those options waters. Maybe you're considering doing so on behalf of your clients, and you want to know, how do I get started in this stuff? Well, we got you covered. Also, maybe if you're out there looking for a new advisor and you want to maybe know what skill sets they should bring to the table, all of you are welcome here on the Advisor's Option. My name is Mark Longo from the aforementioned network, as well as, of course, from the ever-evolving, soon to have a new face on it, theoptionsinsider.com. Stay tuned for that. I know I've been saying that for a while, but it's coming. I promise you. A little bit delayed, but it's coming. And by the way, if I sound a little bit under the weather, that's because I am fighting through the tail end of a nasty bout of a good winter bout of stomach flu here. But you know what? The show must go on. That's how much we love you here on the Advisor's Option. Neither rain nor sleet nor snow nor horrible illness will keep the program from hitting the airways. But if I'm not at 100%, that should at least clue you in. Luckily, I got a good cast of characters to help me carry on the show. Let's start as we always do. Let's take that needle and let's start up north, and then we'll spin it around the coast. Let's start all the way up in the quiet land known as New Hampshire, where we are joined by none other than Mr. Matt Ambertson, the founder over there at IRAs, a.k.a. Options Research and Technology Services. Mr. Ambertson, welcome back to the program. How go things in New Hampshire? Hopefully you've escaped this nasty flu, sir.
Feeling great, Mark. We're ready to carry you. I'm excited to have Eric on, so let's get this going.
I might need some carrying. If you just hear dead ear on my end for a while, it means I just passed out. So you just keep on trucking without me, and someone will come in the studio and scoop me up and take care of me. So don't worry about me here. All right. And also joining me as we continue to move that hand there on the clock face down a little bit out into the ocean, actually, all the way out to a quaint little island known as Puerto Rico, where we are joined by Mr. Chris Hausman, the portfolio manager, a.k.a. the managing director of risk, a.k.a. the director of risk over there at Swan Global Investments. Mr. Risk Director, welcome back to the program, sir. You know I love that title. I can't get enough of it.
Yeah, you keep going with that. That's fine. But once again, always a pleasure, Mark. 0% chance of snow here.
0% chance of snow, hopefully 0% chance of nasty legacy winter flu. I actually did the right thing. I went warm. I went to the south. I was in Florida for all of last week, and apparently that's what did me in. Who knows? You go to a nice warm climate, and the gods punish you that much more when you come back. They say, okay, you had a good time now. Now you get a double dose of winter in the form of nasty, nasty seasonal flu. And then let's continue that hour on the clock there, the hand on the clock, easy for me to say, around a little bit. We're going to bring it around all the way back and up into Louisiana, actually New Orleans, where I'm pleased to say we are joined, it's been far too long, by our old friend, Mr. Eric Cott, the Director of Advisor Education over there at the Options Industry Council. Mr. Cott, welcome back to the program. And what the heck are you doing in New Orleans, sir?
Well, it is always nice to be back with you, and I hope you're feeling better. And with Chris and Matt, always a pleasure as we're kicking off 2019 here. I am in New Orleans, Mark, because I am speaking at a educational symposium for pensions, endowments, hedge funds, advisors, the whole lot. And it doesn't hurt that it's also Mardi Gras time. And so I guess full disclosure to your listeners, I might have mentioned this back in 2012 when we did our event down here, but I had my first experience when I was 18 years old going to school here at Tulane, and we fast forward to today. I am here in New Orleans for this institutional conference and to also see some colleagues and clients of mine, and I sort of exercised that put bleep that I had, which is basically protecting me from getting sick. I'll knock on wood here that I don't get your illness or anything else that's been going around the country. And more importantly, it's always a pleasure to be on your show and to be with friends and colleagues like Chris and Matt.
This thing is so nasty, it might be able to infect you through the electronic airwaves here. So maybe use a clean wipe, some Lysol after you're done here.
Face mask right now
after you're done here. Let's keep on rolling before I infect anyone any further with a little bit of the old Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101. This is the portion of the show where the name pretty much says it all. We break down a basic options concept and explain how you guys can utilize it in your clients' portfolios. And, we've been talking a lot on the show the last few months in particular, going into earnings season about straddles. Matt and his team do a lot with straddles analysis over there, their earnings move and result reports. And it kind of occurred to us, maybe we should take a step back and do a little bit of a deeper dive into what the heck we mean. It's a very basic term for us, but people are coming to this universe, to this marketplace for the first time. It may not be as readily apparent what the heck we're actually talking about, what the use case is, and all that fun stuff. So we thought we'd start our Options 101 this episode doing just that, doing a deep dive into straddles. So let's start there. Maybe let's go around the horn. Matt, since you're the keeper of the straddle data, maybe we'll start with you. What the heck are we talking about when we mean a straddle, sir? What exactly is it? And then even more importantly, what is it useful for? What's it good for?
Yeah, I remember going to the floor and not having too much exposure to options, and people were talking about straddles and strangles, and I thought I was in a different world. But and there's some very colorful language that's used down there. But a straddle, maybe you're straddling the fence. You are voting. If you're long a straddle, you're simultaneously buying a put and a call at the same strike. So straddling the fence, you could either go up or down, but you do want it to move at least more than the additive premium of both of those options, and for you to make a profit. So that's just briefly in a nutshell what a straddle is. We use it quite a bit here for testing. It's a good way to look at, for example, with earnings coming up, you might look at a straddle price to see how much the market expects the market to move, and so we look at that quite a bit. We do more sophisticated things like try to extricate the premium that might be left over after an earnings move. So we try to identify what the earnings move is going to be. You could see all that in our blogs that we put on your site, Mark, the Options Insider blog. We talk about how we set those types of thing up. And so, the straddle is a very important way to look at option strategies, to look at volatility, and then to translate volatility into expected moves. It's kind of a great tool for us to look at, Mark. So that's a brief overview of the straddle.
Yeah, it's one of those weird positions. It's one of those weird strategies, right, where it is a strategy and it certainly has a direct trading impact, but it's in many ways perhaps even more useful as an indicator. And you can't really say that about a lot of strategies out there where you can look at them as a very useful indicator as well. But the straddle, in many ways, is almost more useful as a tool than it is as a direct trading application. Chris, you guys out there at Swan are trading a lot of things, not a lot of straddles, I don't think, but still there's a lot of utility in them, even for you guys. So maybe some thoughts first on maybe your thoughts overall on straddles, maybe their utility or lack thereof, and what it is you guys use them for.
Yeah, I think straddles don't get enough love. I use them predominantly as a better gauge of what true volatility is. Your at-the-money options consist of only volatility. And I know everyone uses the VIX out there, but what people need to realize about the VIX is it's a whole strip of strikes. And when you start moving away from your at-the-money strikes, even though you could put a straddle on any strike, but I guess we're talking here about at-the-money stuff for all intent and purposes. As soon as you start incorporating a huge spectrum of strikes, you're talking about all these different things like skew and kurtosis and all this stuff that we've mentioned on this program before. So it kind of starts The VIX incorporates a lot of these different things, but if you really, really want to assess what volatility is doing, you always want to look at your at-the-money straddle. And I still look at the old VIX, which is under the ticker VXO, because it's just a couple of the strikes above the at-the-money and a couple of strikes below the at-the-money. So it doesn't have all this skew. It doesn't have any of this kurtosis or measurements when you're looking at these baby options, meaning 1, 2, 3 delta options that can kind of affect the VIX calculation. So, we don't necessarily trade straddles per se here. We do use them in conjunction inside of other strategies, which I think we're going to get to here, like iron butterflies. But yeah, we kind of do a variant on the straddle, which is a strangle, which is just another premium harvesting strategy. It's kind of a extended straddle, call and put on different strikes. But I think the utility, to just kind of sum all that up, is if you're really, really talking about volatility, knowing what you're at the money straddle has to be part of your toolbox.
Yeah, you're right. You could start going crazy with in-the-money leg straddles and things, but we're not going to bother with that. 99% of your use case listeners for straddles are going to be that at-the-money call, that at-the-money put. You add them together, that's your straddle. In fact, we were on the trading floor, and when you used to do the straddle runs, that's what it would be. They would give you a run of all the at-the-money straddles across all the different expiration months and whatever product you were looking at. And why would you do that? Well, that gives you, like Chris and Matt just said, that gives you a snapshot of what effectively the at-the-money implied volatility is on all of those different term structures. So that's a very useful thing if you're looking at a product and you want a snapshot in one single glance of what's going on out there. And as Chris alluded to, some of the issues going on now with the VIX. The VIX started off, it was pretty much straight up at the money volatility, first of the OEX and then of the S&P, the SPX. So it was effectively like getting that good old at the money straddle. And then they started adding different nuances to it, legs like adding in the skew. And a lot of people welcomed that, including myself. I thought it was valuable information in those different wings. It's not all about the at the money, but at the end of the day, that's where people have had some problems now as a result, and that's the lawsuits that are coming up against the VIX now. A lot of people want to maybe go back to the old methodology, like Chris mentioned, which was kind of just a straight at the money without the skew, which can cause some of those inherent complications. And we've seen some new products coming to market now that are attempting to do just that and kind of go back to the old way of looking at just straight up at the money volatility. So there is a lot of utility there in at the money volatility. Eric, you're out there when you're not leading parades through the French Quarter out there these days. You're out there on the road, pretty much boots on the ground. It's one of the reasons you're not on the show with us all the time is because you're busy out there being the boots on the ground guy, talking to all of the advisors around the country about options and how they could use them. Do straddles come up very often in that conversation? And if so, in what capacity?
It's interesting, Mark. I wouldn't say they come up frequently, and I'm going to sort of leverage back to, the study that we released in 2017 with Cerulli, that kind of focused on strategies advisors do. One of the things, you got two really wonderful guys on between, Chris and Matt, and yourself also being on the floor. I never had the experience of actually being a trader on the floor. I was on the Philex as a sell-side kind of institutional guy, but never had the battle scars that all of you do. But it's funny. I learned a lot of these, the nomenclature from the three of you and others like this. And, someone said to me at one point, way to know the difference between the straddle and the strangle. Straddle, think of like the same letters, the two D's in it, it's a common strike price. And then with the strangle, you have, sort of different strike prices. And, I hear from advisors relative to the ones that utilize maybe more esoteric strategies that, when there might be some earnings that is on the horizon, that's where they might deploy a straddle. They've got to be, kind of more proactive with it, in terms of, moves that are going to happen in the underlying. But I'd say more, on the straddle side that we hear that. But, look, at the end of the day, the reason why you sort of introduced this segment is that you have a number of advisors that are familiar with it, others that kind of want to get reacquainted. And, this is one of the values. That you're, you're looking at ways to just not say have one direction, but you're going to gain maybe moves either, up or down relative to the underlying. And I think there's value to it. And I love the quote from Chris that I might steal that, Chris, that straddles don't get enough love.
Straddles don't get enough. That could be the title of our show here. Straddles.
A T-shirt, Chris. I hope this one comes up with that T-shirt because I'd like a version of it.
You're making me laugh here. You're killing me. You're killing me over here. But yeah, that is a good point. They don't get enough love in some cases. Other cases they get maybe too much love in the wrong circles, which is another one of the reasons why I wanted to do this segment. We'll get to that in a little bit. But first, let's round out some of the use cases for straddles. Like we mentioned, it's an at-the-money call, at-the-money put, very basic. So let's say your proverbial, your at-the-money call is $2, your at-the-money put is $2. Add them together, $4 is the net cost of your straddle. Obviously, there's an implied volatility level, implied, pun intended, by those prices. So that's where the use case comes. A lot of people like to look at the volatility side. For a lot of the retail who like to look at net direction around a time like earnings, for example, that $4 net total is also a useful number because it shows you exactly what the market is predicting in terms of movement. And the nice thing we like about it, and the reason we talk about it and we have the straddle reports up there on our website, is because at the end of the day, that is real money. That's real money predicting what's going to happen around a particular event. And every analysis, every study that's ever been done shows at the end of the day, you can have all the analysts, all the whisper numbers, all the quote-unquote experts weighing in. At the end of the day, real money is going to blow their doors off 99.9% of the time because that's where the real, truly meaningful analysis is being done because there's real money on the line. So we look at straddles as a much more meaningful indicator than any sort of analyst estimate or whispered number or anything like that when it comes to an event like an earnings. We can apply the same analysis to crop reports. Whatever the event risk is, the straddle will price that in. And you can look at it and say, oh, this is too rich. I think they're pricing in too much, or maybe they're pricing in too little. So in that case, our $4 straddle I mentioned before, if you think the underlying is going to move more than $4 over the life of that contract, then you could buy that straddle and hopefully make money. If you don't think it's going to, you could sell it, which is also a risky thing because then, of course, if it moves in either direction more than that $4, that could come back to bite you. So those are some very, very basic use cases for straddles. Let's talk about the other side of that, though, what it's not useful for. And that's one of the reasons why I wanted to do this, because it's kind of gone away now, thankfully. I think education has helped kind of stymie this myth. But there used to be a lot, particularly in the early days when we first launched the Options Insider. There used to be a lot of it was late night infomercials and other things coming at you, and they were hitting you with this tagline of, make money in any market condition using options. And that's how they would tell you. And it's a very attractive pitch. It sounds great. Hey, I don't need to be right on direction. I could just make money no matter what happens. And what they were pitching you, they didn't say that. They were pitching you straddles. They wanted you to come out and just load up and buy straddles. And hey, it sounds great. How can I lose, right? How could I lose buying a position, in this case, a $4 straddle that, how can I lose? Because at the end of the line, all I got to do is move and I make money on this, right? Not so much. Matt, you and I and everyone who spent some time hedging a position on the floor, you realize quickly how easy it is to lose being long a straddle, sir. So why don't you walk our listeners through maybe some of the downsides? It seems so attractive on the surface, right? You buy this thing, $4, you're good to go, right? You're making money no matter what happens. Let's walk them through some of the downsides of why maybe it's not as enticing as it may initially seem, sir.
Yeah, it is difficult to make money owning straddles. We've done tons of tests, and it's rare to find stocks that you can make money owning straddles. If I could tell a brief story, back in the day on the SIBO, when I was backing traders using my own capital, we didn't want to be short straddles, so we were trying to find stocks where we could be long straddles, and we came up with some interesting methods for calculating historical volatility based on what we used to call scalping gamma, or delta neutral hedging a straddle. So what that means is when you buy a straddle, you're kind of 50-50. You don't care if it goes up or down, but once the market starts going up, your call starts getting richer and it starts moving faster with the movement in the stock. So that implies a higher delta. So delta just means the more profit that you have as a stock moves a dollar. So if the stock goes up, you want it to keep going up if you own a straddle. So we did a lot of studying with stocks, like should you be hedging them a lot, or in which amount should you delta hedge? Some stocks like IBM we always used to tell our traders to let IBM run, but stocks back in the day that they were trading, like in Amazon, that was moving a lot intraday. Or I had Nextel, and that was moving a lot intraday. So those you'd want to hedge, even do an intraday hedge to, what I like to say is hedge your happiness. If it goes up, you might want to sell some stock, because then you're not rooting for it to go up farther. I don't know if that makes any sense, but that's what we used to think about. So, it is very difficult to make money owning straddles. A lot of the people that are out there trading options, they put a premium in there for owning options, and so there's an extra kind of premium out there that you have to overcome in order to own options. The saying was, owning options like having cancer, you die a slow death, whereas if you're short options, it's more like a heart attack when the stock moves. And so that's one way to think about it in your head, where the risk of being short a straddle is if the stock moves a lot, and then you really can lose a lot of money. Whereas owning a straddle, usually you just have that what's called theta, like there's an expiration date that's coming up, and that your straddle is ultimately going to be worth just the difference between where the stock price is and where the strike price is. So that's in kind of a general feel for what we're doing around straddles. It's very difficult to make money. You can find those diamonds in the rough, and that's what we try to do. We would put people in certain pits based on that kind of those historical volatilities that we found that if we hedge it a certain way, we could actually make money or break even. But it's a very difficult thing to do, Mark.
Yeah, that's a challenge. I like that. Hedge your happiness. That's a good way to think about that, because it's totally true. It's what you're doing, right? You're cutting off your upside. Hopefully not too much if you do it right. Gamma scalping. I think we have a listener question about that a little later, so we'll get into more in that in a little bit. But you're right. It is that's where I started to realize the art part of the science that was market making and options trading, was that the entirety of that subset of skills, which was scalping the gamma, which was getting back to what we're talking about here. Remember, listeners, why do we say it's so hard to make money being long a straddle? That seems like a no-brainer. You buy this thing, the stock moves, you make money. Everyone's happy, right? But remember, you're buying not just one contract at the money, you're buying two. So first off, remember back to those episodes we've had early on of the Greeks. And remember, if you talk about at-the-money strikes, now we talked about theta. Matt just brought it up, theta, which is time decay. Remember, options die a little bit every day. Your at-the-money options are going to die faster. They have the highest rate of theta decay of any contract out there. So you're not just buying one, you're buying two. You're buying at-the-money call and at-the-money put. So now you're getting exposed to effectively twice as much theta decay on that strike as you normally would with just one contract on that. So that's something to bear in mind. You buy this $4 straddle, let's say the stock sits there for a couple of days. Now you come back in, nothing's happened. And guess what? That straddle's maybe worth $3.75 now, and so nothing else has happened. You've lost 25 cents on that straddle, and that's going to continue until the thing expires or something happens and it moves. So that's now all of a sudden you need a bigger move to make up for that decay. And that's the reason why everyone points to being long straddles is such a challenge, because it sounds great on paper, looks great on paper. In practice, a much more challenging prospect, and as Matt alluded to, requires a lot of analysis, a lot of research, and a lot of skill to make it profitable over the long. I'm trying to think. I can't really think of anyone I know who's at least when I was on my time on the floor, who was extremely long a lot of premium and made it work time and again. So a lot of guys who were short a lot of premium, and that worked until it didn't as well. But crazy long ton of premium and laughing about it all the way to the bank, not a ton of those, which is maybe telling in and of itself. Chris, this is obviously an issue you've encountered and probably still do, managing your positions over there at Swan. So some of your thoughts about straddles, time decay, and if you have any analogies about the dark art of gamma scalping, have at it, sir.
Yeah. So I think one of the issues with straddles is, or any type of volatility trading, is being lulled into a false sense of low absolute volatility. I remember back in 2005, 2006, when we were in a very low volatility regime back then, and everybody was complaining, kind of like, what Matt mentioned. You just saw your long book just erode slowly every single day, and it lasted for years. It wasn't just a few months and then volatility popped again and gave you a chance to get out of your positions. This was something that lasted for a long time. fast forward to 2017, and what did we hear? My goodness, volatility is so low now. But you want to know what? 2017 was the year of the option seller, not the option buyer, because even though you're in an absolute low volatility environment, there's this relationship that you have to trade. And that relationship is the difference between realized volatility, right? The volatility of the underlying or stock movement versus what the options are implying. And that's really the key component of trading volatility, whether you're doing it through straddles or strangles. And I do agree with Matt 100%. If you're going to be long straddles, you have to have some element of gamma scalping. That gives you a much higher rate of success with that kind of strategy. And I know when I was on the floor or had just left the floor and was still kind of trading as a liquidity provider upstairs, I had much more success with lower priced options that were still moving around. And the reason being is because a lower priced option is going to give you a lot more gamma than higher priced options. So, there's this strategy out there called dispersion trading. And just to get it real quick, I mean, people are generally doing what? They're selling index volatility and they're buying equity volatility. Well, because they're going to get a lot more gamma for their buck by buying straddles on equities and then trying to fund that through the index. So I think if you're going to be a gamma scalper, if you're going to be long straddles, you really need to look for, those gems those gems out there in the form of smaller price stocks that are going to give you a high gamma.
Yeah, it is interesting. You do have to play defense if you have any sort of long exposure to premium or indeed straddles, which is why we're looking at some alternatives here to make straddles a little bit more useful. A lot of people out there, advisors, asset managers, others, maybe don't have the wherewithal, don't have the margin capacity or the time. It takes a lot of time. You just heard Matt, explaining how much effort they devoted to proper gamma scalping technique. It's not a mean feat by any means. It takes some time and effort, and a lot of advisors out there, asset managers, don't really have the time for that. So there are some other ways you could perhaps upgrade a straight straddle position. It has utility. The position has utility, but maybe as a leg, a component of another position, it might have more utility. And that's what we're going to explore next here. A couple of ways you can maybe upgrade a straddle, maybe make it a little bit more useful for you and your clients. One of the ways I think of, and if I'm going to use any sort of straddle, which I don't use very often, if I do, it usually comes as part of this strategy, which is called an iron butterfly. I know, crazy name, scary name, dumb name. It's a name of a song from the 70s or early 80s. Why do we use that stupid name? Don't ask me. But the actual position is actually much more useful. And what does it do? Well, it involves exactly what we're looking at here, which is an at-the-money straddle. Could be a long straddle if you want to go long the iron fly, short straddle if you want to go short it. But then you're adding another leg to it, which is a strangle outside of it. Remember, a strangle is kind of like a straddle, just stretched out away from the at-the-money. So you're taking an out-of-the-money call and an out-of-the-money put, and you're trading that against your at-the-money straddle. So let's say in our case you had your $4 straddle we just talked about. You bought the $2 call, $2 put at the money, put them together, you spent $4. Now you're saying, well, maybe I want to do a little bit of hedging. Maybe you sell, 10% out of the money call on that, and you get maybe $1 for it. And maybe you sell a 10% out of the money put, and you get $1 for that. And now you've taken off, you've added the other $2, you've taken off, in our little example here, pretty much half the cost. So you've reduced your risk by half on that straddle. And so that's one great way to kind of, not quite gamma scalp, but reduce your net outlay here on the straddle, which at the end of the day, if you're going long premium on these, is certainly something you need to consider. Obviously, if there's a huge home run, it's going to clip your returns on that, so bear that in mind. But in general, it's a great way to mitigate your risk on these types of strategies. The same also applies the opposite way. Let's say you sold that $4 straddle, and now you buy those wings. Now, of course, you've given up half of your returns, but also you've kept yourself from potentially maybe blowing out if there is a disastrous move against you. So it works in both regards. It works as a way to hedge against a short position or as a way to mitigate, offset some of your outlay of a long position and keep you alive in the fight, live to trade another day, which is the goal for you and for your clients at the end of the day. Another way to upgrade it is kind of dialing back from the straddle a little bit, which is take that straddle and now stretch it out into what's called an iron condor. Again, I know, another stupid, old, outmoded name. Don't blame me. I didn't come up with them. But in general, you're taking that at-the-money straddle, and some people are a little bit intimidated by that. At-the-money straddle has all the time decay we just talked about, has all the risk inherent to it that we just talked about. They don't want to deal with that. So they'll take that instead and take that at-the-money straddle, maybe stretch the at-the-money call up out of the money a bit and stretch the at-the-money put down out of the money a little bit. Now what they've got is an out-of-the-money strangle. And maybe they want to buy that instead. And then they go out beyond that and trade a farther out-of-the-money strangle, maybe sell an out-of-the-money call and sell an out-of-the-money put against it. So now you have one out-of-the-money strangle against another. And effectively, you've created what's called an iron condor. What's the benefit of this? Well, you could tell it's a little bit away from at-the-money, so you're not as impacted by the time decay right away. So that's a nice thing for some people who are concerned by that. The flip side of that, of course, is you're not going to get as much of immediate bang for the buck. As you are if you're trading the straight-up at-the-money straddle or the iron fly. I had a friend on the network once who jokingly referred to the iron condor as an iron butterfly for cowards. That always cracked me up. I don't entirely agree with it. I see this use case for both, but it is a funny way to describe these two. And Matt, one of the reasons we like having you on here is whenever you come to the show, you come armed with some data, sir. So I know you went out and you actually crunched the numbers for us. What is the IRAs data telling us about all things iron fly, iron condor, and straddle, sir?
Thanks, Mark. Yeah, as you know, ORATS has a back tester. It's online, and I could hit a few buttons and get some answers for you. So I think it's going to be helpful to actually reiterate some of the things that you just said, but put some actual numbers around it. So I'm going to talk about it from the short side because a lot of the reasons that you would do an iron butterfly where you're adding a long component to the short straddle is that you you can then as a retail or someone could sell some premium, and the iron condor is the same way. So what I'd like to do is kind of look at some of the returns, some of the risk, and talk about those strategies. So a short straddle, a lot of us can't do that because of the high margin that it takes. But if you run that against the SPY since 2007, your average annual return with the stock as or the notional return is 4%. So what that means is over those number of years, 12 years or so, you've averaged 4%. Well, obviously there's down years and up years. 2008 was a large down year, with the SPY down on something like 38%, the short straddle was only down about 10%. So, and the reason it didn't go as far as being long the stock is because you're selling that premium, and that premium is bigger and bigger and juicier. And so you don't lose as much on the downside as you would just being long the stock because you have that extra premium from the calls in that case. So now keep that in mind, the 4% annual returns with the 10% drawdown in 2008. So now an iron butterfly is one where now you're purchasing more options, and those options are going to weigh on your returns. So you get about a little worse than half of the performance. So it's 1.5%. Is the annual return, but your loss is only about half in 2008. So you only lost about 5%. So you could start to see that you're having your returns, or a little more than having your returns, but you're also having the risk. And then the iron condor halves itself again. So you're only making a little less than 1% per annum in the SPY. And then your actual drawdowns just about 1% better, so pretty similar to the iron butterfly. So I think it's an interesting comment. The iron condor is the iron butterfly for cowards, and it actually looks in this case like the iron butterfly has some better statistics in the SPY. So it's I've never heard that comment before. So I always get something from this. But
1%
anyway, so
for the iron condor. That's not exactly attractive.
Right. Well, so when we talk about returns and notional returns, we're not talking about returns on the margin or the amount of capital you have to put out. So if you factor that in, the iron butterfly does have some attractiveness vis-a-vis the annual returns that are cut, but you don't have the same risk, Mark.
Yeah, it does seem like for a while there, I think maybe 4 or 5 years ago, iron condors were kind of all the rage. Everyone was doing them. Everyone was talking about them. A lot of services are out there pumping them as the next big thing. Then it seemed like a lot of that kind of went away. Maybe I think some of your data may be a reason why. Maybe at the end of the day, they realized, these iron condors aren't really lighting it up. If you do all that work for 1% in the SPY at the end of the day, that's not exactly something that's going to maybe get your clients, not beating down your door to come back and renew with you for the next year, I don't think. Chris, any thoughts on maybe these ways we've put here to upgrade the traditional straddle position? Maybe you have your own thoughts. Maybe you have your own funky 1x3x8 type of thing you like to do with straddles, sir. So what's up your alley down there when you're looking at straddles and potentially upgrading them?
Well, I just want to start off by saying that an iron condor is 2 iron butterflies. So you can go back to your friend and tell him that one. As far as the at the money set and forget iron butterfly, it's actually been pretty challenging. It's been challenged over the last 10 years since about 2010-ish. And I'm just using the SIBO's index B-fly. They've got a lot of great indices out there for a lot of different strategies. But, unfortunately, the unmanaged or passively managed, if you want to call it that, set and forget at every single expiration has kind of not performed well since 2010. And I think when we employ iron butterflies or iron condors, we're a little bit more tactical, trying to okay, well, if the market has run up a lot, well, we're not going to do an at the money. We may do some type of out of the money version, and which is going to cost a little bit less than your at the money version, and hopefully the market goes back inside that zone, and then you can profit from that. So it's just a little spin-off. I know we're always talking about at the money type strategies, but I think butterflies and condors can also be employed tactically if you're doing it a little bit above the market or below the market, depending upon what kind of analysis you're using or what your opinion of the market is.
Yeah, you're right. We just touched on the iron fly really here, but if we get into the whole, one of the reasons we did just that is because if we get into the whole world of butterflies, maybe that could be another episode because there's a lot to unpack there. Your standard butterfly, your skip streak, strike / broken wing butterfly, the various permutations of butterflies are legion. And we could spend many days, and they also incorporate what is effectively a straddle leg to them as well. So those also are a way. Maybe that might be something to put a pin in for a future show. Do a deep dive into all the various permutations of butterflies. We've been talking straddles for a while here. We'll kind of wrap it up there. Let's give the final word here to our friend, Mr. Cott, beaming in from New Orleans. Sir, any final thoughts you have on general straddles, maybe some of these upgrades we've suggested, like the iron condor, the iron fly, or maybe there's something else you got up your sleeve in terms of straddles you want to leave us with, sir? Have at it.
No, I'm going to give an endorsement to our man down in Puerto Rico. I mean, that's one of the things that Swan, again, has utilized and is also why there are other managers like them out there. I mean, you talk about multi-legged strategies that at times become overwhelming to advisors to implement. Start getting into discussions, Mark, about margin, and then I think you touched on really eloquently the fact that sort of these get-rich schemes from folks that are on late night TV offering strategies to straddle that you're never gonna lose money, and we all know that that was even the case back in 2007 when people were saying you weren't going to lose money, you could go into some esoteric investment. And I think you have to know what you invest in, but also know what your parameters are. Look, I mean, I'm going to give a slight endorsement or a slight shout out to the OCC here because look, I can't tell you, Mark, that we can sift through all the volume numbers to tell you where most of the strategies were going in 2018. But I know that Matt and Chris, and this, that we traded record volume last year at OCC. Was as far as our history goes, we cleared over 5.1 billion contracts and options. And I think what that is saying is that more of your listeners and more individuals and institutions and advisors are using this. And I think it's valuable that you're bringing this up. Again, I think that the advisors that tend to implement these strategies, from my experience and me being out in the field, tend to want to hire somebody else to help manage these positions because it does. Matt touched on it with his analysis. And with Chris, it just requires more time and more attention. And Chris said something about setting it and forgetting it. And I'm going back to sort of this, strategies or investments where, a structured product. And Mark, I won't bring that up because I know that raises the hair on the back of your head. But a structured product with an embedded option in it is one of those set and forget it. And it really isn't. You have to be proactive with that. So those are some of my insights, relative to the discussion.
All right, now, since you mentioned the numbers, it's time for us to keep on rolling into a quick edition of The Buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, everybody, welcome to The Buzz, a portion of the show where we break down the news that you guys may have missed in the world of options. Eric just alluded to it. January numbers are in. We're almost close to getting the Feb numbers now. At this point, it'll be interesting to see how we're looking for February. But January, as Eric alluded to, the second highest volume January in history, trailing only, of course, last year, which, as you know, listeners listening to this program, was a record year, kind of blew the doors off every other record. Of course, 2018 was kind of the year of the return of volatility, had a lot of somewhat unprecedented events going on. We had the VIX-ocalypse, call it what you will, there in February. We had the real moment where the worm turned for the bull market there in October, on October 11th. That also drove a lot of volume. We had other sustained events like the trade war driving a lot of sustained volatility. We also had aberrant events like the government shutdown coming in at the end. So we had a lot of foreseen and unforeseen events really coming in and kicking in and adding to that maelstrom of volume and volatility, which led to a record year. So probably not too surprising that 2019 would be record, but maybe not quite meeting that level. And that's pretty much what we saw over this past January. Let's break it down a little bit here. Overall options volume, 416 million contracts. That's pretty robust. But again, everyone thinks of February as the big volume month of last year. And certainly it was. That's when the worm turned for the first time. But January last year is actually far more active than people remember, as it was 467, almost 468 million contracts. That's a ton of paper. And so January doesn't really get the love. So we're comparing it against a very active month. Equity options volume, 375 million contracts. Cleared ETF options volume, about 158 million contracts. Index options volume, 41 million contracts. Futures are where the interesting stuff is, 6.3 million contracts. That kind of reflects, this is the interesting time because last January was the last we still had XIV and those products in play. February is where, of course, the VIX-ocalypse happened. All those products effectively got shut down. And so a lot of the big drivers of VIX futures, which is the lion's share of that number of what OCC clears on the futures side, it went away. So it'll be interesting to see going into next February how it looks February on February. But right now, the futures were down substantially because this year compared to last year, because there are no products like XIV driving a lot of VIX futures volume. And we've seen that now reflected over there in things like the CBOE's stock prices and things as a result. There's not a lot of drivers right now for VIX futures. Speaking of all things OIC and OIC Advisor, Eric, since you're on, I know you guys have made some new additions to the team over there as well, including you guys have a new team lead over there in terms of Paul Finnegan. Am I correct, sir?
You are. Actually, we are bringing in a former CBOE guy that the three of you know, who also was running NYSE ARC and has now joined us as the vice president and overseeing that. We've had a change of position on the team in terms of the field, and we've now moved into a starting position of institutional. Your friend Joe Burgoyne, and I'll give a shout out for myself here, Mark. But this month actually is a decade that I will be celebrating in OCC. So for the three of you and your listeners, it's pretty shocking to me as well that a 10-year time frame I've been in this marketplace, but I've been very blessed. And so, a lot going on with that. We've got some research that we're going to release when we're down with you at our May conference. So our work is never done.
And if you're saying to yourself, I can't get enough of that Eric Cott guy, particularly with his 10-year anniversary, then we got some good news coming up for you. We're going to save that, a little bit of a tease. We're going to save that coming up in the end. I want to make sure some of you guys get on the show as well. We talked a lot about straddles at the top, but it's a very important subject. But let's move on into some of your questions here with a little bit of the old office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours, a portion of the show where we hang on our shingle and you guys come at us with your questions, your comments. This one actually came into another show, and I said, you know what, we got to save this for the keeper of the earnings options data, Mr. Matt over there at IRAs. We can't really answer it properly without him to crunch the numbers. This comes from Euro20. He or she wants to know, how do you play earnings that has a lower IV rank, so a 30-day implied volatility rank, than an IV percentile? And he says 52-week, and he gives an example of a ticker here, which is 1OK Inc., ticker symbol OKE, OKE, which is trading right now 65.5. I'm not that familiar with this ticker, but I have an idea what he's talking about here. But Mr. Matt, I won't step on your answer. I know this one's right up your alley. What do you want to say for our friend here, Euro0, wants to know about lower IV rank versus IV percentile, sir?
Well, I think he's on the right track. You know, one of the things that you want to do when trading earnings is to develop a strategy and really create a niche for yourself. So, I mean, this is what we do with IRAs, and we present our data on your site. Is we test about 7 or 8 signals, and one of them is this kind of IV rank, HV rank versus historical. So it's in the same flavor as what Euro0 is talking about, and that is one of the better signals that we have. And what I would suggest when these people are looking at these types of, somewhat esoteric signals is really, look at a bunch of data. Like, so for example, when we present on your site, Mark, we have 1,000 stocks. A lot of these signals have, 200 or more examples from the last earnings cycle, and then we present each quarter's earnings cycle. So you want to get enough data to develop a signal that's replicatable. So, I like the direction that Euro0 is taking. I think that one of the ways that you would play a stock like this is to do what I just said. Look at, is the straddle paying off? Is the strangle, or is it not paying off? We talked about that at the top of the show, but then come up with your, so that's going to give you a feeling for the magnitude potentially of this trade, and then I would look to not necessarily trading the straddles for the same reasons that we mentioned before because of the risk, but to try to find an option, like as Chris said, a small option potentially that can make a lot of money, that you could trade around finding the signals of these IV rank versus IV percentiles. Mark.
Yeah, well said, sir. Again, Euro20, it's a good question to hit up Matt and his team over there. Maybe they could crunch some back tests for you. We, of course, have a lot of that data available for free over there at theoptionsinsider.com. But if you want some, sort of custom, maybe you want this Oki one, maybe a custom back test, they could do that for you over there. That's a great way to look at it. In general, we've kind of held off when you've heard us talking about earnings trading a lot, with Matt and on other shows. It's kind of a crapshoot either way. The data kind of doesn't really endorse one way or the other. Long premium or short premium, they both end up losing and winning with about equal percentages. So it's just one loses more dramatically than the other. But other than that, they both can end up have their pluses and minuses. So that's why we don't really endorse a lot of straight up earnings trading. But there are some unique scenarios, and maybe you pointed one out. I'll have to look at this Oki a little bit myself and see if I can come up with some ideas for it. But in general, I think that's a good approach, and hit up Matt and his team for maybe some specific types of back tests, and that could help you out here. We've got time for one more here. Mr. Cott, glad you're here with us. You can answer this one. This comes from Bantam Bantam Tom. Let's go with Bantam Tom. He wants to know, do most advisors out there primarily trade options in IRAs? Well, I think I have an answer for this one, but Mr. Cott, you're out there, you're with the OIC, so you know the answer to this. What do you have to say to Mr. Bantam Tom? Are most advisors out there primarily trading options and IRAs for their clients these days, sir?
It's a good question. I appreciate him asking that. I would first say that most advisors aren't necessarily trading options. They might be trading it for themselves in their own IRA accounts, but typically they're not necessarily trading. But what's interesting also, Mark, is you know this, other gentlemen on, Chris and Matt know this, that certain firms, primarily the registered investment advisor firms, are the ones who allow certain type of trading in IRA accounts, multi-leg, et cetera. So, in terms of the regional broker-dealers, the wirehouse and stuff, at times very limited to be able to do any type of option strategy in a qualified account like an IRA account. But from my travels and discussions with advisors, it is interesting that for themselves, they might be deploying strategies where they're kind of doing it more on a short-term speculative basis, but not necessarily doing that when they're managing client assets.
There you go, from the horse's mouth over there at OIC. Mr. Chris, you guys are always interacting with advisors as well through your 10th box events and other types of outreach you guys do over there at Swan. What do you have to say for Bantam Tom? Where are advisors slinging the options these days, sir?
Yeah, advisors aren't primarily trading in options and IRAs. One of the things that we do here is we manage IRAs and separately managed accounts. And so we are able to do the defined risk strategy in a lot of IRAs. And then one of the things we've been doing is helping a lot of advisors out there. They just assume that you can't trade options in an IRA. Granted, the margin requirements are a little stiffer, but you can definitely employ a lot of different strategies in IRAs and a lot more than what people think are out there. So, yeah, I think there's still a lot of push in the advisor space to trade IRAs and programs like this, and then Eric out there doing all that hard work and traveling to Mardi Gras and things like that. That's what's helping us get more option volume, and volume breeds more volume. We all know that, so it's a good thing, and it's how we, at the end of the day, is what we do. We manage our risk. And congratulations, Eric, on your 10 years. That's awesome.
Much appreciated.
We all are thankful for Eric making the sacrifices that he does for us. If he wasn't the queen of the Mardi Gras parade, where would the options industry be? All these years later.
That is right.
Taking the hit for the team on that one. Well, that music, unfortunately, means we come to the end. What a great discussion we had today. Took a deep bite out of the world of straddles, so hopefully that dispelled any maybe misperceptions you maybe had about them. Maybe you had some questions. Maybe you have more questions about them. I think we already brought up some interesting permutations we can dig into on future episodes, like flies and things. So there's a lot of places we can go with that. That's kind of just the tip of the iceberg of talking about all things straddle and some of the use cases they have therein. But before we go, let's go back around the horn. I want to start with Mr. Cott. Because we don't get him on here very often. He's off busy being parade marshals everywhere around the country. But also, it is his 10-year anniversary coming up at OIC, and we're going to mark that occasion here on the network in a pretty fun way. Mr. Cott, I know it's not ready yet, but it's pretty close to ready. I've heard the raw version. Do you want to tease our audience with perhaps what they can look forward to coming fairly soon?
Well, there won't be a parade in Illinois or anywhere else for that. So only in New Orleans today at the Mardi Gras parade. But as we're coming upon this 10-year anniversary, sort of the end of this month, early next month, as we all know, it's a podcast blog launch that's happening. So we're quite excited about that on the OIC side. And I'm just overwhelmed by the amount of support and such we're getting from others.
So very soon. Very soon.
I was wondering where that music was coming from.
Well, that's coming from us. That's our music there. And pretty soon you'll be able to hear his own music on his own show. Yes, we're going to be launching a program aimed specifically at this audience called Coffee with Cott. So you get to sit down. Eric's going to tell you all about his favorite blends from Nicaragua and the Dominican Republic and Colombia. They'll compare and contrast, French press versus different styles. No, I'm kidding, of course. It's going to be all about kind of what we do on this show, but also interviewing advisors, talking about other trends out there. A lot of interesting stuff. So if you're in this audience, you're excited, you want more content, Eric's got you covered. That first episode's in the can. I've heard good chunks of it. It's coming along pretty well. And it's going to be hitting the network hopefully soon. So stay tuned for that very shortly, listeners. I'm very excited to have that. We don't generally get to launch new shows very often. So when we do, it's a big deal. We're very excited about that. Coffee with Kots coming to a podcast player near you very soon. As you mentioned, there's also going to be a blog to go along with it over there at optionseducation.org, and a lot of good stuff, maybe some events and webinars. I was joking on that show, maybe Eric's going to be kind of our undercover man. We're going to send him out he's always at various events. Maybe we'll wire him up and have him go into these events so you too, listeners, can be a fly on the wall at these various events, and he could pull people aside and have some conversations and interviews. So a lot of cool stuff. Look forward to that here. Am I selling it enough for you, Eric? Am I excited enough for you?
More so than ever, Mark. And again, I also want to thank Matt and Chris, because both of their firms and the support that we get interfacing with them as well. But, again, the show really is it's sort of an offshoot of what we do at OIC. And I'm speaking for the OCC and the OIC folks, in Chicago and Texas as well, that we really do appreciate all that you do at Options Insider Radio, because it really does spread the gospel out there. And, we're still trying to convert a lot of people.
Well, we do it rain nor sleet nor shine nor, in this case, horrible flu will stop us from talking and spreading that gospel of options. And I don't know if they're quite as dedicated over there because they're in happy and scenic and sunny Puerto Rico, but they still are devoted to the cause. Chris, what's cooking over there in the land of Swan, and maybe the 10th box events and all the other cool outreach you guys have going on?
Sure. Well, we are just as dedicated, and we have a new white paper out called Avoiding the Big Blow Up, Why Options-Based Strategies Fail. So that takes a deeper look at leverage, liquidity, and risk controls in options-based strategies, and as well as preparing for our RIA forum in Chicago. That's going to take place April 28th and 29th, and you can get more information at swanriaforum.com.
Geez, it's almost time for that again. I can't believe it's almost been a year. That's mind-blowing to me. So maybe it's the flu-induced fog speaking right now, but it doesn't seem like it's been almost a year since we just did that, does it?
You're one day closer, man.
I'm one day closer. Don't make me laugh. See, you're killing me over here. But check it out. And by the way, I can't imagine what would have inspired you and the research team to do a paper about options-oriented blowouts. I don't know why you would do such a thing right now. It's not like we saw a legion of those over the course of the last year or anything like that. Check it out. SwanGlobalInvestments.com is a good place. You can, of course, get episodes of this show, but also great white papers like he just alluded to. They have the Swan blog, the good, the bad, and the ugly. A lot of good content over there. So if you're listening in this space, you want some content in between episodes, got optionseducation.org and you got SwanGlobalInvestments.com. Those two will keep you busy in between episodes. And who knows, maybe you register for an event. OIC is coming to town, I believe, in Naperville soon with an educational event. The Swan guys are always doing stuff, and they're coming to town with their big forum in April. So if you're in Chicago, you're doubly in luck recently. So check them both out. And last but not least, Matt, you're not coming to, I don't think, to Chicago anytime soon, but what do you have up your sleeve for our audience these days, sir?
Yeah, we are very dedicated to it, ORATS, and we're being recognized for that at the Option Industry Conference in May. We're going to be on a panel talking about how we're bringing in new volume, and there's a rumor that someone else is going to be on that panel, but I can't say it yet, so I'm excited for that. Talking to Jill Malandrino down in New York in a couple days at a Quandle Data Conference, so that'll be fun. We're blogging all the time. We've got some great new research on presenting signals. You talked about January of 2018. We had some good signals that the market was getting frothy, and so we're talking about some of those signals and avoiding being short volatility at some very dangerous times in the option market. So we're excited about that and about all the outreach that we're doing, Mark. And of course, being on here with Chris, and congratulations to Eric. So that's what we got, Mark.
There you go. Check them out over there at orats.com. That's, of course, Options Research and Technology Services. Give them a follow on Twitter at OptionRats. It's a handle you can't easily forget. So check them out over there. A lot of great data coming in between. So, again, you're looking for content in between episodes of this program. You're waiting. You're champing at the bit there for the new episode of Coffee with Cot to come out. You're like, what can I do with myself in the interim? You got a bunch there. You got optionseducation.org. You got swanglobalinvestments.com. And you go crunch out some back tests over there. Check out the blog over there at orats.com as well. So you guys got no shortage, no complaints in terms of keeping yourselves busy in between episodes. So on behalf of Mr. Cott and Mr. Matt and Mr. Chris, a.k.a. the Director of Risk, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing. If you're listening live, stay tuned in about an hour. They're putting me back to work here, even though I'm about on death's door. We're going to be talking all sorts of crypto with the Crypto Rundown in about an hour. Stay tuned for that. Otherwise, we'll see you next time for more of The Advisor's Option.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.